Welcome back to What Matters. My name is Drew Devine. I am a managing director on PwC's Treasury and Financial Markets team. And once again, I am back here in PwC's beautiful studios. And once again, I'm in conversation with my colleagues, Sandra Cook and Ross Drucker. And we are here again today to talk to you about what matters in risk management, what matters in hedge accounting, but most importantly, what matters to you. Now, on our first edition of What Matters, we talked about 4 foundational areas that corporate treasury practitioners need to consider as they're contemplating their own risk management journeys. We talked about planning, we talked about executing, we talked about accounting, and we talked about reporting. On today's edition of What Matters, what we want to do is take a deeper dive into that first foundational stage, the planning stage, and we're going to look at it through the lens of internal stakeholder alignment. It's an absolutely critical stage to overall hedge program success, and it's one I'm actually personally pretty passionate about just based on my own consulting experience. Now, many times when we embark on risk management and hedge accounting journeys with our clients, we consider ourselves to be somewhat of translators within the organization. So helping the treasury function talk with FP&A, talk with accounting, and other areas of the firm. Now, Sandra, once again, I want to turn to you first here because I know this is an area that you are also pretty personally passionate about because you have a lot of learnings from all the consulting engagements that you have been on and the journeys you've helped clients with. So why don't you start us off, Sandra, and give us a sense again of some challenges that you've seen clients encounter in this very foundational stage of planning and internal stakeholder alignment. In short, once again, tell us what matters.
Yeah, thanks, Drew. And you bring back, both my corporate practitioner days as well as my advisory days. And I think if there is a challenge to be experienced, I probably have been through it either personally or with clients. And so I just wanted to highlight what I think are some top 3 for me. And one of them is really thinking that I had the ability to mobilize and control a global organization in establishing an FX risk management program, especially for those future forecasted transactions. As a practitioner, we had a fully blown balance sheet hedging program. But when I was challenged with kind of taking that a little bit further and looking further back in the timeline, that was a really big challenge. And I didn't really understand it as much. So I really focused on getting an executive sponsor. It seemed extremely critical to break down barriers and to have somebody I could rely on that supported the initiative. Secondly, you brought it up, Drew, stakeholder alignment, making sure that I aligned with existing processes and procedures and didn't ask for new information in a different way. Because data is already existing from FP&A in the planning and budgeting process. You should be tagging along with those things. So those 2 things in terms of me thinking that I could control this situation was humbling, at the same time challenging. The second challenge that I would say is Treasury has this sense of balance sheet ownership. Right. Managing monetary assets and liabilities and cash is king, but that was a transition because the business that drive transactions don't think about assets and liabilities. They actually think about revenues and expenses. And as a result, those are the same transactions. I just needed to change my vocabulary and bring in some new jargon. And when I did that, I was able to make leaps and bounds progress with implementing a risk management program. And then the third one that I think is important is data perfectionism. This concept that my data has to be accurate to get started. And I would say that exposure capture, data collection is an art, it's not a science. That you should start with what you know, and you should apply some business concepts to it, and those things will get you started, and it doesn't have to be perfect.
Interesting. Really great insights there, Sandra. So, Ross, I want to start drawing you into the conversation a little bit more here as well. Now, when we are out doing consulting engagements, whether that's from the risk perspective or the accounting perspective, many times we focus on this concept of ensuring that the hedge program economics is aligned with the underlying accounting. And from my perspective, that sounds like almost the very definition of internal stakeholder alignment.
Right.
So, Ross, I mean, just based on your experience from that technical accounting perspective, what are some of the unique challenges you've seen clients face in that very specialized area when it comes to aligning the accounting function with the rest of the organization?
Yeah, that's a good point, Drew. I think critical to the success of any sort of hedging program, right, is having the alignment between Treasury, accounting, and financial reporting, and to your point, Sandra, like other stakeholders who may be involved or have a piece of this. But since the technical accounting and reporting requirements can be a bit overwhelming, that's an area where you see people struggle at times and need help. And especially at first, if it's your first time doing this, you're expanding into a new program, whatever it may be, that's an area that typically clients will need a little bit of help in terms of the accounting side. So, with that, right, it starts with identifying the exposures, it starts with the documentation, and then your effectiveness testing approaches as well, and outlining in your technical accounting policy. That's sort of your best place to start, especially for U.S. GAAP, it's ACA 15. It's strict accounting rules by nature, right? It's not intended to be free play. You can do whatever you want. There are rules in place for a reason, and so while you get the benefits of hedge accounting under ACA 15 or whatever applicable gap or guidance you're following, there are rules that come with it that you need to follow. And so having that policy, that's sort of the foundation for compliance and for your accounting, and your controls and everything else that will fall into place as you go through the policy and put that in place. And those policies generally cover everything from exposures to how those exposures will be hedged, what instruments you're going to use, how they're going to be designated, and what type of hedge they're going to fall under the guidance, how assessments of effectiveness will be performed, all the way down through the financial reporting, and where journal entries will be booked according to GAAP, depending on the type of hedge you're doing, so on and so forth. So, like I said, I think that's an area where we typically see corporates and other companies need additional support. It's an area that if you're not involved in it all the time, if you remember, either of you, the old days before ACA 15, it was a gigantic green book that everyone had on their desk, right? And so there's a lot of guidance there to think through and a lot of things to consider as you go through this. But hedging in general, right, is designed to basically have you be able to put derivatives gains and losses in a place that makes sense relative to what you're actually hedging. And so that's why those rules are in place, so that there's no free reign on being able to park gains and losses somewhere else in the financial statements. But I think going back to the beginning of your point, Drew, I think having alignment between Treasury and accounting and financial reporting through the policies, through the discussions, starting with the exposures, but all the way down through the financial statements, is really something that at times we've seen people struggle with on the back end of having a program put in place because they don't have that up front. And I think having that put in place is really the sort of critical factor here, especially when we know that there's a lot going on in terms of compliance, at least to get going. And then once you have it in a good spot, you can get it to kind of run off into the future as you keep monitoring it over time.
Interesting. Once again, a lot of great insights here. These are indeed the things that matter. I think one of the key elements we pulled out of today's conversation, both from you, Sandra, as well as yourself, Ross, is just across the board, from that initial exposures phase to the ultimate disclosures phase, is the critical importance of aligning those internal stakeholders. Now, I'm going to summarize kind of very quickly here. Sandra, you had mentioned like the challenges sometimes in, and we'll say, going it alone. So how important it is to engage the business early. That's something I jotted down from you there. You also talked about focusing in on the things that matter, the exposures that matter. It doesn't have to be perfect out of the gate. And Ross, a couple things I jotted down from your perspective: the importance of just outlining a clear accounting policy. And I also think you dialed in a little bit that theme of exposures to disclosures there as well, right? So taking it end to end. A lot to consider, but once again, these are the things that matter. Now, if you need help in your own risk management journey, or you need assistance with hedge accounting advisory or hedge accounting managed services, contact us at PwC's Treasury and Financial Markets team, or stay tuned for the next edition of What Matters. Sandra, Ross, myself, we will see you next time.